Buying a car is one of the biggest financial commitments you'll make, and while it can be exciting, it's also where many dealerships use tactics to get every dollar they can, often at your expense. If you're not prepared, you could end up paying thousands more than necessary. Today I'm breaking down the most common tricks that dealerships use to profit off customers, along with detailed steps to protect yourself, negotiate better deals, and make sure you're getting exactly what you need without hidden costs. By the end of this video, you'll be fully equipped to walk into any dealership confidently. Let's dive in. Part 1. How dealerships maximize profits at the customer's expense. The low monthly payment trap. Dealerships often focus on low monthly payments to make a car seem more affordable, but they achieve this by stretching out the loan term to 6, 7, or even 8 years. While this reduces monthly payments, it increases the total interest you pay, making the car significantly more expensive over time. For example, a $30,000 car might have a 3-year loan option with payments of $850 a month. The dealership may offer an 8-year term to get payments down to $400, but with added interest you could end up paying well over $36,000 in total. To protect yourself, ask for the total cost of the car, including interest, for each loan term. Don't let monthly payment figures distract you. Focus on the overall cost to understand what you're truly committing to. Steering you toward leasing or PCP plans. Leasing and PCP, personal contract purchase, options are popular with dealerships because they keep customers in a cycle of payments, often with no ownership at the end. Leasing might feel more affordable monthly, but you're essentially renting the car, and by the end of the lease term, you may have paid thousands without any equity. For instance, if you lease a car for $300 a month over 3 years, you pay $10,800 with no ownership afterward. PCP plans often lure you into upgrades at the end of the term, keeping you in a continuous cycle with new payments each time. To protect yourself, if you plan to keep the car long-term, buying or financing with ownership in mind may be a better option. Calculate the total amount you'd pay with leasing versus financing, and ask yourself if the monthly savings are worth losing ownership. Inflated prices and extra fees. Dealerships commonly add fees to increase their profit margins, such as documentation, advertising, preparation, or even delivery fees. Some of these fees may be negotiable and others are simply unnecessary add-ons that customers can challenge. For example, a documentation fee might be listed at $500, but this is often an administrative task that costs the dealership a fraction of that. Other charges, like advertising fees, might seem reasonable, but they're often already accounted for by the dealership. To protect yourself, review each line item on the invoice, and don't hesitate to question any fee that looks unfamiliar. Ask if the fees are required by law or if they're negotiable. Politely request to have unnecessary fees removed and walk away if the dealership won't adjust them. High-priced add-ons and unnecessary extras. Dealerships earn substantial profits from add-ons like extended warranties, paint protection, gap insurance, and more. These extras are often marked up by hundreds or even thousands of dollars, far above the cost you'd pay for the same service from a third-party provider. For instance, an extended warranty at the dealership might cost $2,000, but a similar warranty through an independent provider could be less than half that price. To protect yourself, if you're interested in an add-on, do your research beforehand to see what it would cost outside the dealership. Don't feel pressured to make a decision immediately. Take time to compare prices from other providers. Marked up interest rates on financing. Dealerships often partner with banks to offer in-house financing but will mark up the interest rate to earn a profit. If the bank offers a 5% rate, the dealership might offer it to you at 6% and keep the extra 1% as commission, which can add up to thousands over the life of the loan. For example, if you're financing $30,000 over 5 years, a 1% markup on the interest rate can add over $1,000 in extra interest payments. To protect yourself, get pre-approved for a loan through your bank or credit union before visiting the dealership. Use the pre-approval rate as leverage, and ask the dealership to match or beat it. If they can't, consider sticking with your pre-approved loan to avoid higher interest costs. Lowball trade-in offers. Dealerships often make low offers for trade-ins, sometimes compensating by slightly discounting the new car. While this can make the overall deal seem fair, you may be getting much less than your trade-in's actual value. For instance, if your car is worth $10,000 on the market, The dealership might offer $8,000 but give you a $1,000 discount on the new car, pocketing the difference. To protect yourself, research your trade-in value on sites like Kelley Blue Book or Edmunds, and consider selling the car privately if the dealership's offer is too low. Don't be afraid to negotiate or ask for a fairer trade-in price. Rolling negative equity into a new loan. If you owe more on your car than its current value, dealerships may roll that negative equity into your new loan, giving you the illusion of starting fresh. In reality, this increases your loan amount, making your payments and total costs higher. For example, if you owe $5,000 on a car worth $3,000, a dealership might add the $2,000 difference to your new loan, keeping you in a cycle of debt. To protect yourself, avoid trading in your car if you're upside down on the loan. Pay down the loan or wait until you're in a positive equity position to avoid adding old debt to new purchases. Mileage and condition fees on leased cars. Leases often include strict mileage limits and condition requirements, which means you'll be charged for excess wear and tear or any additional miles driven. These fees are a significant way dealerships make money off leased vehicles. For example, if you exceed a 12,000-mile limit by 1,000 miles, a fee of 25 cents per extra mile can add $250 at the end of the lease. To protect yourself, calculate your average yearly mileage before signing a lease, and ensure it fits within the terms. Keep the car in good condition to avoid wear and tear charges, and ask about potential penalties up front. Part 2. A guide to protecting yourself at the dealership. 1. Research car prices and financing rates in advance. Use resources like Kelley Blue Book or TrueCar to determine the fair price for the car you want. Also, get pre-approved through your bank or credit union for a loan rate so you know what rate you qualify for outside the dealership. 2. Establish a clear budget before visiting. Determine your ideal down payment, monthly payment, and loan term. Keep in mind that extending the loan term increases total interest costs, so focus on what you can afford comfortably over the shortest feasible term. Focus on total cost, not monthly payment. Make sure you're aware of the full cost of the car, including interest over the loan term. Ask the dealership to show you the total amount you'd pay for each loan option, rather than just the monthly payment. Be skeptical of add-ons and question their value. Dealerships often mark up extras heavily. Politely decline add-ons like warranties, gap insurance, or paint protection unless you've researched the prices independently and know what you're willing to pay. Question every fee and don't be afraid to negotiate. Ask for a breakdown of fees like documentation, advertising, and dealer prep. Politely ask for any unnecessary fees to be removed, and be prepared to walk away if they won't adjust them. Compare the dealership's interest rate with your pre-approval. Here's a tip. Use your pre-approval as leverage to negotiate a lower rate. If the dealership can't match or beat it, just stick with the financing you've already arranged. Research your trade-in value. Knowing your trade-in's actual market value helps you avoid low offers. Use Kelley Blue Book or Edmunds to find a fair trade-in price, and consider selling privately if the dealership won't offer a reasonable amount. Avoid negative equity by waiting to trade in. If you're upside down on your car loan, try to pay down the balance before trading in. Rolling negative equity into a new loan keeps you in debt, so avoid it if possible. Review the lease terms carefully. For leases, ensure your mileage limit matches your typical driving habits. Check the penalties for exceeding mileage or for wear and tear. Negotiate a higher mileage limit if necessary. Don't rush. Be ready to walk away. The ability to walk away is one of your strongest negotiating tools. Don't let the dealership rush you or pressure you into agreeing on terms that don't work for you. Buying a car is a big decision, and knowing these tactics can help you save money and avoid common pitfalls. Remember to stay focused on the total cost, question every fee, and take your time. With these steps, you'll be well prepared to negotiate confidently and secure the best deal possible. If you found this guide helpful, please share it with friends and family who might also benefit. Thanks for watching, and good luck on your car buying journey.